Earlier in the week, DBS reported a 43% jump in Q1 profit to a new high from a year earlier. Today, I read that the Monetary Authority of Singapore decided to punish DBS again. DBS would now need to apply a multiplier of 1.8 times to its risk-weighted assets for operational risk, bringing its total additional regulatory capital to approximately $1.6 billion. This is up from the multiplier of 1.5 times imposed in February 2022 after DBS was also hit by a major, two-day disruption in November 2021. Online banking and ATM services by DBS were disrupted by a system issue on May 5. There was a similar day-long outage on March 29, although DBS said the incidents were unrelated. Ho Hearn Shin said the repeated inconvenience caused to the public was unacceptable and that DBS had fallen short of its expectations for banks to deliver reliable services to customers. How badly is this going to impact DBS and their investors? Capital requirements are standardized regulations that determine how much liquid capital banks must hold for a certain level of assets. A higher capital requirement may inhibit an institution's ability to invest. So, it locks up some capital as a safeguard. It would have a very small effect on the bank's ability to generate returns for shareholders. It is probably negligible. This wouldn't have an adverse impact on the health of the bank. The Common Equity Tier 1 capital ratio takes a hit, but it isn't too bad. DBS added that this latest development would have an incremental 0.3 percentage point impact on the bank's Common Equity Tier 1 capital ratio, reducing it from 14.4% announced in March 2023 to 14.1%. This is still very high and still contributes to the prevailing idea that DBS is a safe place to leave our deposits. It also contributes to the idea that DBS is still relatively safe to invest in. What is Common Equity Tier 1 capital ratio, you asked? Capital is required by banks to absorb unexpected losses that arise during the normal course of the bank's operations. Common Equity Tier 1 capital covers liquid bank holdings such as cash and stock. The ratio compares a bank's capital against its assets. I also want to say that the response from the bank's CEO, Piyush Gupta, once more affirms my confidence in DBS. We apologize for the digital disruptions that have recently occurred. Our customers rightly expect more of us and we are committed to doing better. The global financial crisis of 2008 created an opportunity for DBS to fill the void left by the Western banks that were suffering from its aftermath. Piyush Gupta, a former Citibank executive, successfully reconciled the passive local culture of DBS with the more proactive and competitive culture he brought with him from Citibank ever since Piyush Gupta took over the running of DBS. I have seen how the bank has improved in so many ways over the years. If the market should massively sell down the common stock of DBS next week, I hope I would be smart enough to buy some. That I doubt it would happen, but a price of $30 a share, maybe. If AK can dream, so can you.